Liability is the chapter we are discussing today. Liabilities are at their simplest amount that a business owns. Generally, at some point in the future, it is probable that the business will have to pay out cash or other benefits as a result of past transactions or events. Examples of liabilities are loans from banks, money owed to suppliers, creditors. Similarly to assets, liabilities which will not be paid for at least 1 year are called long term loans, whereas that will be paid in less than 1 year are called current. You may also find items like provisions in a balance sheet. These are either used to make reductions in the value of an asset or liabilities where the amount or timing of the payment is uncertain. Characteristics. The characteristics of liabilities are given below. Any type of borrowing from persons or bank from improving a business or person income that is payable during short term or long time duty or responsibility to others that entails settlement by future transfer or use of assets, provisions of services, or the transactions yielding an economic benefit at a specified or determinable date or on occurrence of a specified event or on demand. A duty of or responsibility that obligates that entity to another, leaving it little or no discretion to avoid settlement, and a transaction or event obligating the entity that has already occurred. Classification. Liabilities are reported on a balance sheet, hence, they are divided into two categories. Current liabilities. These liabilities are reasonably expected to be liquidated within a year. They usually include payables such as wages, accounts, taxes, and account payable. Unearned revenue. When adjusting entries, portions of long-term bonds to be paid this year, short-term obligation that is from purchase or equipment curve. You can see the current liabilities, which are some examples are given below. Typical current liabilities are account payable, notes payable, current maturities of long-term debts, dividend payable, short-term obligations expected to be refinanced, customer advances and deposits, unearned revenue, sale tax payable, income tax payable, employee related liabilities. Long-term liabilities. These liabilities are reasonably expected not to be liquidated within a year. They usually include long-term bonds, notes payable, long-term leases, pensions, obligations, and long-term product warranties. Mentioned below are long-term liabilities. You can see one is tax supported bonds, long term warrants, long term notes, capital lease obligation, unfunded compensated absences, unfunded pensions, long term portion of judgments, pollution remediation obligation, etc. A debit decreases a liability, a credit increases a liability. Example, if merchandise inventory is purchased on account, the account payable liability is recorded by making the following journal entry: purchases is debit, account payable is credit. You can see the liability account payable, here we are going to credit it. This is an example. You can see the for the sake of recording on a liability.